Hi, my name is Linda Abraham. I'm the president and founder of Accepted, and I'm going to be the moderator for today's webinar, How Will You Fund Your MBA Abroad? The webinar will actually be presented by Michael Hollis, the Associate Relationship Manager at Prodigy Finance. And I always like to start the webinars by learning a little bit about our audience. I know Michael's interested also in this information. So can you please post in the question window where you are located, city and state in the United States, city and country outside the United States. Again, where are you located geographically? Okay. Toronto, Canada, Bangalore, Maine, Bangalore, India, sorry about that. India, Estonia, New York City, Cape Town. I think that's where Prodigy Finance is actually from. Nigeria, all right. Pune, India, Tehran, Lima, Peru, Taiwan, Mumbai, Vancouver, Uzbekistan, okay, India, California, all right, neighbor. Michael is currently in San Diego and I'm in Los Angeles. Bridgetown, Barbados, all over, really. Anybody else want to post? Where are you from? Where are you located, rather? Okay, Bangalore, Filipino working in Singapore, okay. All right, anybody else wants to post? Please feel free. I also have a couple of polls I want to launch, so another one in Johannesburg. Okay. When are you planning to start your MBA studies? That's going to appear on your screen in just a second. Please select the item that is most relevant to you. The options are 2017, 2018, 2019, or later. Again, the question is, when are you planning to start your MBA? 2017, 2018, 2019, or later. And with 75% of you have voted, can we get up to 80%? 5, 4, 3, 2, 1. I'm closing the poll with 80% of you having voted, and here are the results. So it's 31% 2017, 60% 2018, and 9% 2019 or later. Okay, that's pretty much what I expected. Good. All right, let's try another question. Let's see. And next question is, how much of your tuition do you plan to intend to borrow? I'm sorry, that's the question I was looking for. How much of your tuition do you intend to borrow? Okay. And the options are 100%, 65, 50 to 99%, 25 to 49%, less than 25%, or 0, but I'm here just in case. All right, we have 73% having voted, and there is a clear winner here, but let's see if we can't get that up. Anybody else want to vote? 5, 4, 3, come on, get up, 2, 1. Okay, we're going to close it. We hit 80%, and here are the results. 100% in terms of tuition is 16%, all of it you want to borrow, and then comes 65 and 11 and 8, and everybody intends to borrow something, so nobody falls into that last category. Okay, and then final poll from me. Now I will introduce our guest. This seems to be in the news right now. Did the U.S. election and President Trump's immigration policies change your views on applying to, on where you're applying? Okay. This is interesting. Okay, so it's a close vote here. Very interesting. All right, 5, 4, 3, 2, 1. With 85% having voted. It's really close, folks. Here are the results. Almost as close as the U.S. election. Yeah. That's kind of interesting, isn't it? Yeah. Okay.
Oh, wow.
Isn't that something? Okay.
Yeah.
All right. Okay. Now that was fun, but little housekeeping item, a few housekeeping items. Michael may ask questions during the presentation and ask you to raise your hand in response. You can do so by clicking on the hand icon, two icons underneath the horizontal arrow on your control panel. Can you please click on it just to show me that you know what I'm talking about and that it's working? Okay, great. Yeah, you guys got it. Wonderful. As usual, we're looking forward to answering your questions, and we've set aside time for Q&A, and I see that one person at least already posted one. So feel free to enter your questions in the question window, and we'll choose those that have the broadest application at the end of the webinar. And if we don't get to your specific question, we'll provide an option for you to get answers at the end of the webinar. No matter where you are in this very international crowd, and this is of course why you're here, you need to face reality. An MBA can be invaluable, but it's also expensive, very expensive. And before you can benefit from the education and the degree, you have to figure out how to pay for it. We've observed here at Accepted that obsessing endlessly about financing an MBA education won't help, and ignoring the issue, frankly, can be devastating. And that's why we've asked Prodigy Finance and Michael Hollis to join us today. We'd like to recommend a middle ground called purposeful planning for the expense of an MBA education, and that's what Michael's going to address. Now let's turn to the webinar. Accepted is delighted to host this webinar for Prodigy Finance. Let me just tell you a bit about Prodigy and our presenter. Prodigy Finance was started by 3 INSEAD MBA graduates who experienced firsthand the difficulties of financing an international MBA. Since they graduated, they have set up a platform to provide reasonably priced loans to international graduate students and above average returns to investors. Our presenter today is Michael Hollis. Michael is Prodigy Finance's Associate Relationship Manager. He has a passion for fintech, trying your city's best restaurant, and building the perfect record collection. Michael, the floor, or should I say the mic and screen, are all yours.
Thank you so much, Linda. And it's great to kind of be with you guys today. It's exciting to see so many different people from lots of different places. Just give me a second here. I'm going to transfer the screen to mine.
Yeah.
And hopefully,
there you go.
Perfect. As Linda mentioned, my name is Michael, and I am an Associate Relationship Manager with Prodigy Finance. I'm excited to say that this is Prodigy Finance's 10th year of being in operation. We have been serving kind of the top 100 MBA programs for, I would say, 7 years or 3 years completely. The first 7 years was really kind of spent understanding the European market. So our first 7 years were really kind of spent, addressing the EU and UK market respectively. And over the last 2 to 3 years, we've really kind of been starting to pave the way through the United States and Canada, not just approaching graduate business programs, but also graduate programs in engineering, graduate programs in law, and graduate programs as well in public policy. To date, we have supported over 118 different nationalities. I think, and we'll talk a little bit about this a little bit later, but we've had an outstanding performance on our loan portfolio to date with under a less than 1% default rate, which we think is kind of, it's super exciting for us. It's super exciting for our bondholders and investors. And we think we really kind of do that through our community-driven approach, which I'll talk a little bit about in the slides to come. So far, we have dispersed over $260 million in loans, which is super exciting. A lot of paper, if you will, in under just over 10 years. We are able to support over 150 different countries legally. And I say 150 different countries. We have that cap on there because there is a legal statute called the New York Convention, which is it's an elaborate kind of arbitration statute, and it really kind of enables us to enforce our loans in 150 different countries. Outside of those 150 different countries, unfortunately, if a country had not signed the statute, we actually are unfortunately not able to lend to those countries. Typically, the 2 biggest countries that we see where this affects students are students coming from Taiwan, or students coming from Sudan and Ethiopia as well. But for the most part, a lot of larger countries around the world are countries that we can support, so typically no problem there. We have all of those countries in our frequently asked questions section of the website too, if you just want to take a look at that list. I'm excited to say that this number, the next number that I want to give you, over 107 employees. It's been very exciting to see that number increase over time. So I started working with Prodigy Finance in 2015, December of 2015. At the time, we were about 45 to 48 people across 3 different countries, London, Cape Town, and New York. And now that number is actually substantially larger now. We're about 125 people across these 3 offices, and we have 2 full-time employees who work through India. So they're not based in a particular city. We don't have an office in India, but they work full-time working through India. I'm very appreciative to have them as part of the team. As I mentioned, we have 3 global offices. Cape Town, interestingly enough, so it's great to see some South Africans on the call today, on the webinar today, is our largest office. It's where the bulk of our operations team sits. It's where our members of our risk team sit, as well as software development, and our CEO is based out of Cape Town as well. He often also works out of our London office. We're a UK regulated company, and that is where you will find business development for Europe and the rest of world schools that we support, as well as some marketing activity. Risk also sits out of London, and then in New York, which is the office that I sit in, we are exclusively a business development or growth team. Not to get too technical, but I just wanted to ask just one question, if I could, real quick. I'm just very curious to understand, how many of you have heard of Prodigy Finance before? Just want to quickly ask that question.
Let me put the poll up, or you have the poll up. Okay, great.
Okay, we're at 80% voting. Let's see if we can get to 100.
More ambitious than I am.
Okay, we're close enough. We're at, let's see if we can get to 100. We have 9% left. No, not going to get there. Okay. Okay, so interesting. We have 64% saying yes, 36% saying no. Okay. Just want to share that out. Interesting statistic there. Okay, I want to talk a little bit more about the key benefits of working with Prodigy Finance. We are a no cosigner, no collateral, no guarantor option. So unlike a lot of other lenders out there, we really assess a student, prospective student, on their ability to repay the loan. And that's super important for our model. And as a result, we actually don't even accept cosigners or collateral for any Prodigy Finance loans. You'll have a grace period of the entirety of your course plus 6 months after graduation. So that gives you a little bit of, that alleviates your mind a little bit. You won't have to worry about kind of what repayment looks like until 6 months after you graduate. Now, it is important to say, particularly in a rising interest rate environment, we actually do not penalize you for repaying your loan if you want to do that a little bit earlier. So if there's, if you have, if you take an internship and you actually have a little bit of money that you've been able to save up over the summer of that internship, and you want to start paying down your loan, you're more than welcome to do that, and we're not going to penalize you for doing that. So while there is a grace period of the entirety of your course plus 6 months, you're more than welcome to start repayment at any time throughout your process. It's just after the 6 months has elapsed post-graduation that repayment will formally begin, and there will be a requirement attached to that. There is an administrative fee of 2.5% of whatever the principal of the loan amount will be. That's always going to be the number. You won't have any other fees that are attached to your Prodigy Finance loan. We don't ask you to do anything upfront in terms of payment. That's essentially what amortization means. It just means that whatever 2.5% of your principal loan amount is will be baked into your loan, so you'll be paying that administrative fee along with your loan. For example, as I stated in the first, just a few seconds ago, if you want to just repay, if you just want to pay whatever the administrative fee is up front, you're more than welcome to do that. So less interest is accruing on the principal and getting compounded. So you're more than welcome to take that strategy if you'd like. We make that available to you as well. If you are going to school in the U.S. or Canada, obviously if you're going to a U.S. school, tuition will be given to you in U.S. dollars. That's the way that the loan is going to be dispersed. Unfortunately, right now, if you are going to school in Canada, the loan is still going to be dispersed in USD. Repayment will be in USD, so that's something you should factor in. However, we are working and we're kind of gaining some traction on being able to denominate a CAD loan. We just are not there yet. So as of right now, any loan that you would take from us to go to a school in Canada would be denominated in USD, and repayment as well would also be in USD. Okay. And feel free, as Linda mentioned, we'll be answering questions towards the end, but feel free if there's something that comes to mind, feel free to just pop it into that question box over there on the right-hand side of your screen. The next slide is really talking about some things that you should consider before you start your program in terms of how you should be thinking about funding your education. For us, we are only able to fund up to 80% of the cost of attendance for a course. So at bare minimum, you should be thinking about how are you going to obtain the additional 20% that would comprise the 100% cost of attendance figure for you. We have a few kind of different options that are very popular with students that we support. The first one is personal savings. I will include family savings as well. A lot of times what we have found is that students who come to us, they use kind of a combination of personal savings and family savings to fund that 20% or some portion of that 20% that they are asked to come up with in non-debt funds. Obviously, scholarships are another thing that we find a lot of students use to bridge the shortfall and get them to that 100%. Understanding that increasingly year over year, one of the strong trends that we have seen is that scholarships have become increasingly more difficult to get. However, we certainly do encourage you to start looking around for scholarships earlier and earlier in your search. As soon as you know that an MBA or a graduate business program or a master's in engineering is the right step for you, that's really when you should start looking for scholarships, both from the schools that you would be going to, but also outside sources as well. Particularly for graduate business students, this is kind of what we've seen at that level, and in some cases, LLM and law. Perhaps company sponsorships are also things that are available to you. Obviously, not everyone gets this benefit, but it might be worth, if you are thinking about returning to your employer post-degree, it might be worth opening up a conversation with them and seeing if this could be an option for you as well. Obviously, these tend to be non-debt options outside of the reality that you would have to return back to that company post-graduation. So if that's something that you're thinking about doing anyway, it might not be a bad idea to just reach out to that employer and see if that's an option for you. We also, very similar to personal savings or family savings, is gifts from friends and family. I know when I was going to school, I told just about everyone and anyone who would listen to me that I was going to school. And oddly enough, many family members, many friends helped me financially on that journey by contributing a few dollars here and there to get me along on my way to Columbia in New York, which if any of you are heading to New York is not a cheap place, and Columbia is not a cheap school. So certainly that's the case for many of the schools that we support. So certainly do kind of just talk to your friends, talk to your family, let them know that you're going to graduate school. Many of them find it in their heart to kind of help support you along that journey. So that might be an option for you as well. And then the last two options here are really kind of, we're looking at one of the options that we can provide, a loan. Obviously, you guys are looking into that option by being here today. And then the second thing that is also a debt product, it's not one that we carry. We have a loan agreement year over year. So if your loan is, if you're in a 2-year program, you'll get a loan for your first year and a loan for your second year separately. Whereas with credit unions, for example, sometimes they will give you a line of credit. So where that's different is for our loan agreement, we will give you, say, $50,000 or $40,000 for the first year. You will have that and it dispersed to you, and $40,000 for the second year. You will have that, it's dispersed to you. Whereas a line of credit is, say, you have $80,000 and you can draw from that over the course of 2 years, however, at whatever time that you want. We don't do that. While we are a credit product, we are not a line of credit. So that's something that differentiates us a little bit as well. So how does Prodigy Finance work? So we like to talk about this in kind of 3 buckets. The first bucket is kind of the application process. The second bucket is kind of while you're a student, what does it look like and how do we engage? And then obviously after you're a student, after you've graduated, it's really kind of the repayment process and the repayment cycle. So let's talk about the application process first. As soon as you know the school that you will be going to, you have the opportunity to look on our website, see if it's a school that we support. If it's a graduate school of business, the very clear litmus test for us is if that school is ranked in the top 100 Financial Times rankings, it's a school that we can support as long as it's a full-time graduate program in that school. We do not support certificate programs, and we support part-time courses in that they are MBA courses. We only do that for about 5 MBA programs. The best way to check that is I would look on our website. We have a school page for every school that we support. You can search it in the search bar tool, and you will see a list of all the programs at that individual school that we can support. The application process is pretty straightforward. We ask you to basically put in a few personal details about yourself. As a financial service institution, we are required to understand who our clients are, so that's why we do that there. We also ask you to put together a budget, and if you are going to a 2-year program, we ask you to put together a budget for the first year in real terms, and we ask you to put together a budget in projected terms for the second year. The reason why we do that is because, as I mentioned before, our loan agreements are on a yearly basis. They come up on a yearly basis. So we want to give you visibility into what you should expect for us for your second year, should you not take any additional debt on. And so while we aren't able to extend you a loan for your second year in your first year, we are able to give you visibility into what your second year might look like. And this is a question that often comes up. As long as you don't take on any additional debt in between your first and your second year, or if you take on additional debt with us and we know about it, or with someone else and we know about it, typically you should not see a difference in the offer that you get in real terms for your second year and the offer that you were provisionally approved for that second year in your first. Once you are given that offer, the offer really comes in one of 3 ways. There is a straight decline, and in many ways what that decline will be is if you are over leveraged. And so we use data analytics, our credit-based data model, to understand kind of how much a student can afford. And the way that we looked at is we track the student's performance going into their program, so their salary performance going into their program. We match that against similar candidates that have gone to the programs that they will be heading to and what they've made. And from there, we're able to determine what an appropriate loan size would be. And so both the interest rates and the loan size are determined by a number of factors. These are part of them, and they're really bespoke to each applicant that we have. So that's one way that we could get a decision from us. The second way that you could get a decision from us is we could say, we actually cannot give you 100% of what your ask is. We can give you, let's say, 60% of what your ask is, and we need for you to come to figure out a way to source that additional 40% that would get you to 100% of cost of attendance through non-debt funds. And we give you typically just by default, we give you 2 weeks to figure that out. If you need more time, we work very closely with our clients. So if you need more time, that's something that you should just get back to us with, and we can extend that time for you. But typically the default time to kind of understand what that might look like for you is 2 weeks. And the third way that you could get a decision from us is really, yes, we can approve you for 100% of your ask. Again, that's 100% of your ask and not 100% of cost of attendance. And so that's very easy. If that is your offer, then we move you straight into what we call verification, or that third bucket that you see there, which is providing supporting documents. And the supporting documents that we ask for really help us understand that all the elements in the first phase of the application are in fact accurate. And so we'll ask you for things like a proof of address, your passport information, or your passport, proof of your passport that you have one, what that is, proof of savings if you're going to be using savings for your studies, proof of scholarship, and then a few other things in there as well. So, like for example, we would ask for pay slips. So if you're going to be disclosing your salary in the first phase of your application, so we'll be just asking for proof of that salary. And we get that proof by understanding kind of the history of what your pay slips look like. And then the third thing, or not the third thing, but the last thing that we ask for is a credit report. And we understand that in some countries, a credit report is incredibly difficult to obtain, if not impossible. And so in those circumstances, we don't look at your credit report, but we do look at what we call a letter of good standing, or what is called a letter of good standing from your bank or financial service institution. And that helps us understand kind of your history of repayments, And that's really what we're looking at. We understand that credit reporting is not consistent across countries. So we're not really looking at as much as your credit score as we are as your credit history and your history with repayment and what that looks like. After your verification process is complete, your loan is fully approved. We'll send it to the school for certification. Once the school comes back and says, yes, this student is going to be a student at our school, we certify the loan in the amount that you have indicated. Then we're kind of in a holding pattern until until a school's disbursement date strikes. And so we work with the schools to understand what day tuition is due. We usually send funds across a week before that date, just to give it a little bit of time. If there's anything that is a challenge, we have a week to kind of figure things out with the school. Typically, things run very, very smoothly, so that's usually not a problem, but it does give us some time if things need to be done between us and the school or between us and our client. For funds that exceed the cost of tuition, so if we send a loan across and you are now, that loan puts you over tuition, the school actually sends you either a check or a direct wire transfer into your bank account if you have set that up with the school, in which you can use the excess funds for living expenses. And that really takes, I would say, between 1 to 2 weeks typically, but it really depends on the school that you're heading to or the school that you will be going to understand kind of how much time that typically takes. If you are in a 2-year program, you'll have that same process again. The application process, you'll go through that again. The application process for the second year looks a little bit more seamless. We're really asking you to confirm that the budget you projected in your first year is actually, in fact, the budget that you'll need for your second year. And we do this in 2 ways. We want to, A, understand that you hadn't taken out any additional debt, and B, it also gives you the opportunity, if you actually don't need as much debt funding for your education, to revise your budget downward as well, which you're also able to do. Once your program is complete, you'll have been experiencing this grace period all along. You'll have another 6 months in which you won't have to repay anything, as we talked about, and that's when repayment formally starts. Repayment typically, the loan term is typically between 7 to 10 years, and typically most of the students that we support fall within that 10-year term bucket. Okay. So we talked a little bit about this in the previous slides. It's a question that we often hear from students: how much can I borrow? The maximum or the cap that you can borrow really varies by school. As a rule, all U.S. schools that we support up to 80% of cost of attendance, and that's really determined by the elements that you bring into the application. For the schools that we support in Canada, you can fund up to 100% of tuition through a Prodigy loan. Unfortunately, living expenses are not something that we can do in Canada. And then when you look at our portfolio across the rest of the world, so you're looking at EU and UK, and schools that we support in Hong Kong and Asia as well. It really depends on the school, but for the most part, many of those schools will only support tuition, but there are some schools as well that support both cost of living, and we would be able to do that at up to 80%, and if it's just tuition that we would be able to fund, it will be 100% of tuition cost. And again, just want to be clear, those are all determined by the elements that you bring to the application. So again, we're looking at your pre-program salary, matching that with similar candidates who have gone to the school that you've gone to. We're looking at, how long have you been working, because that's also one of the factors that we look at as well. We look at the school that you'll be going to, a number of factors to determine what those outputs look like. Again, I think the other important point here is that we are not able to send funds or transfer funds directly to clients or students in this case, as it were. We can only send funds directly to schools, and that's something that will not change in the next few years for sure, but we only will send funds to school. So if you're looking for living expenses, to fund living expenses, all of that still must be transferred through the school, and the school will refund you whatever those funds are for you. And the last thing here I just want to point out in this slide is that the average loan size that we've seen, this does obviously vary by school, but across the entire portfolio really has been about $40,000 USD per year. Okay. Another important question that we frequently hear from students, obviously this is kind of one of the more important elements of taking out a loan, And that question is around what my interest rate might look like. And typically, we have kind of a range here that we say as 3-month U.S. LIBOR, which is always going to be variable, plus 5.5 to 8.5% additional to that 3-month U.S. LIBOR. And that margin rate, the number that I cited that's between 5.5 to 8.5%, is going to be fixed. And the variable component of your loan rate will be the U.S. LIBOR rate, which I believe right now is around 1.14, 1.15, somewhere around there. So if you kind of look at this longer term and you're thinking about that, I think particularly given their interest rate environment that we're in right now, I think a lot of students are interested in kind of aggressively paying off their loan earlier, just because, you know, we're kind of in a volatile interest rate environment. And I think across all lenders, interest rates are starting to move up. So that's something to be thinking about as you're comparing lenders across lenders. But to get kind of more into the details of what your rate and how your rate specifically is shaped, your rate is going to be determined by the individual elements that you bring to the application. So we look at kind of the risk that's associated with the country that you have been living in for the past, you know, 5 to 6 years. If you're a little bit younger, we look at kind of what your work history and where that has been. And the reason why we do that is, as a conservative lender, as a default, we're always going to assume that at worst case scenario, the student that we support will be heading back to the country of origin. So we want to factor into that equation the risk that's associated there. We also will be looking at kind of your loan history as well. So if you have a healthy performance repaying back your debts, that also factors into what your offer in terms of what your interest rate might look like. We also do look at the school that you'll be heading to as well. We see that a number of schools have a higher success rate of finding opportunities for their students to exist in either the place where they're at. And so, you know, when we see schools that have a higher success rate of doing that, we're able to, you know, create more and more competitively priced products for them. The other thing that I will also say, and I think it's an interesting part of our business model specifically, is that we also look at whether or not an alum has invested in a loan for a particular school. And the reason why I want to raise that is because when we see kind of alums who are investing in students as well, we see that alums are less interested in necessarily a financial return and a little bit more interested in kind of just obtaining the opportunities to set the stage for the best and the brightest talent to come to their schools. So when we see that alums have invested into Prodigy-specific bonds for students at the schools that they've gone to, we're also able to kind of factor that into a student's interest rate. And like I said here, we work very closely with schools to obtain salary information, placement data as well, to help us shape what some of those interest rates look like. But we're looking at a number of factors to determine what your rate is. I just highlighted a few that weigh heavily in terms of what that looks like. And we offer, you know, obviously a customized offer based off of what your inputs look like. Your output will be directly relevant to what your inputs look like. So that's how we look at rate. And we do this on an individual basis. So that's something important to remember there. We talked a little bit about this in the beginning of the presentation. Just wanted to reiterate it because I think sometimes people will receive an offer and say, oh, if I get a cosigner, will that reduce my offer? Again, I just think it's important to have this slide. We don't accept cosigners, so it won't get you a discount on your rate. And the reason why we do that is, again, because of what we just talked about in that last slide. Our predictive model assesses a student on an individual basis, and we really just don't have the ability to assess, you know, the ability of a cosigner to also repay. So because we're looking at you as a student, we don't accept guarantors, we don't accept cosigners, and we don't accept collateral because that's just not how our model works. Again, I will also say this, you know, in some cases, in very few cases, we have seen where a student has received an offer and in verification, we've looked at kind of what their history of repayment looked like. And in some cases, when that history of repayment does not match what we expected it to look like at the first phase of the application, there have been a handful of very rare cases where that offer that we have presented originally does go up, but that's really when we look at risk. We're looking at risk. We're making a change in that offer based off of risk profile. So that's something to note there. It's something that rarely happens, but it has happened a handful of times. So just want to give you visibility on that. And also give you visibility that, you know, try to fill in that first phase of the application to the best of your ability with the information as accurately as possible. That's what I'm really getting at there. We talked a little bit about this, so this I'll go over this just really quickly. If you're heading to a 2-year program, because we do look at loan agreements on a yearly basis, you will have to reapply for your second year of funding. That second year application process is a lot quicker. It's really just verifying the things that you had mentioned in your first year to make sure that everything is accurate. We have seen that a number of times, particularly with business school students, because you are doing a lot in terms of going to see companies, meet companies, traveling a lot. If you're a part of student lending, if you're a part of student clubs, sometimes there's a financial component to that there as well. So a lot of times we've seen that students have either over budgeted or in many cases under budgeted for their second year. So we give you really an opportunity to assess that the things that you projected your second year to look like are actually what your second year looks like. All right, and just kind of accretive to that as well. As you're going through your first year, here are just a few questions that we always like for students to be thinking about, particularly germane, kind of given how volatile markets have been over the past 2 to 3 years, is you definitely always want to be keeping an eye on your currency fluctuations. And if you do think that there's an opportunity for you to go back home for employment, you certainly do want to be thinking about how currency fluctuations at home might be influencing how much you actually are able to allocate from your savings towards education. As I mentioned in the previous slide as well, social spending is also something that we see a lot of students have actually under budgeted for. So certainly, and we also are developing a tool to help students kind of understand how to budget through an MBA or a graduate business degree program or a graduate program specifically. Because we have seen some students kind of struggle with that because it is sometimes a struggle to do that. But certainly do keep that in mind as you're going through your first year. And then, the other thing that I will also mention is that sometimes students really don't appreciate that if you have an opportunity to get an internship between your first and your second year, that's also an opportunity for you to save money as well. And it's also a great opportunity for you to put some money in the bank to start repaying down a little bit of your loan while you're in school as well. So that's also something that we encourage students to kind of just consider. Obviously, you'll be working very hard throughout the school year, so you certainly should enjoy the fruits of your labor throughout the summer to the extent you can with your internship. But certainly do consider putting a little bit of money, just a good practice, putting a little bit of money away to start repaying some of those debts off a little bit earlier than expected. So do that. The next slide here is really just a representative sample of what a typical or an average loan size might look like relative to interest rates and how things would accrue. So like I said, the average loan size that we typically see is about 40,000 USD. We have here in this representative example an interest rate of 7.5% plus LIBOR. And again, LIBOR as of April 8th was around 1.15%. The only fees that you will incur from Prodigy Finance loans are the administrative fee. Again, that's 2.5% of principal. So in this case, it's $1,000. So in this case, the loan that you have requested from us would have been $40,000. If you add the admin fee, the loan now gets bumped up to $41,000 because we're just adding that administrative fee into the principal of the loan. And then we have the representative APR, and we can talk about very quickly APR in the next slide. We also have a great video, which I encourage everyone to take a look at on our website, talking about APR in a more in-depth way. We understand that this is something that is something that a lot of people who are used to kind of the U.S. credit markets understand, but it's something that we do see a lot of our clients kind of struggle to understand kind of coming in. It's certainly something that I also struggled with earlier on as well. So we have a great video on our website to help explain this a little bit more. But basically APR is the annual percentage rate. So we're looking at your loan size plus all the fees, in this case just the administrative fee, and the annually effective compounding of compounding interest, right? So we're looking at kind of the principal of the loan plus $1,000, and then we're looking at how it compounds on an annual basis. So as you guys know, compounding interest really is principal plus any fees, and then you're compounding that on an annual basis. So your effective rate, I would look to your APR as really what your effective rate looks like. And this is really, the reason why APR is something that we share with you is because this is really the rate that you should be looking at as you're comparing across lenders. So while the only fee that we have is the administrative fee, which is 2.5%, there might be another lending product out there that has an administrative fee. They might have an early draw fee. They may have other fees. So you're really not able to kind of compare different rates across lenders. APR really enables you to do that. And so that's why we give you that APR number as well. And that APR actually can come down if you repay off interest before kind of interest accrues on an annualized basis. So that's something to keep in mind as well. That's one of the reasons why I at least particularly encourage you, if you have some additional funds, to maybe repay off your interest to reduce that APR, what that APR number looks like over an annualized basis. And then I think, I just like to leave this slide up because I think sometimes coming into a program, it's easy to say, oh, I just need $40,000. And I think it's good to see just how much a $40,000 loan, for example, can grow over 10 years, over a 10-year term. So in this representative example, we see here with these market conditions, a $40,000 USD loan balloons into a $72,000 debt obligation that you have on your book. So an increase of about $32,000 just over 10 years. So certainly, obviously, be thinking about that as you're thinking about your minimum loan payment each month. And so in this example, we see $608 would be the minimum loan repayment. But I say that because that's the minimum. You're more than welcome to pay more because, as you see, just over a 10-year term, that's $32,000 that you've been paying out additional to what it was that you owed at day one. So a little bit more about APR, again, just because this is a slide that I think is important for a lot of people to just see here. We're looking at, again, how do we get to APR? We're looking at the simple rate of interest, so it's fixed plus variable. The variable component is the LIBOR component, plus the administrative fee. And again, there's no repayment fees at all, so if you want to repay earlier, there's no obligation for you to do that, of course, but if you want to do that, there's no fee either for you to do that. So it's really just those two, the simple rate of interest and the administrative fee that we're looking at that get compounded into APR, to that APR total. And it accrues monthly, so the first trigger for accruement is going to be the first month of disbursement. So say you signed the loan agreement in August and disbursement doesn't happen until September or October, then interest doesn't even begin to accrue until that first disbursement hits in September or October. So even though the loan has been settled with us, in terms of the process has been finalized, interest doesn't actually start to accrue until the loan has been dispersed. And typically, there will be two disbursement dates. What we'll do is we'll divide the loan for your first year in half. So if it's a $40,000 loan, 20 will be dispersed in the fall. That will trigger one interest accruement. And then the second will be the additional $20,000 will be dispersed to you in the winter term, or January usually, or January or February in some cases. That will be when the second interest trigger starts to accrue. And again, I think this is also just important to note, APR is really meant to be the comparable rate across all lenders. So when you're looking at a number of lenders, it's really the APR that you should be looking at because APR is that number that takes into account all the fees that you could be incurring from a particular lending option for you. Again, because it's a question that we even get from clients sometimes, I just love to reiterate that there are no prepayment penalties at all. So if you graduate, you get a great signing bonus, and you want to repay off your entire loan, you're on day one, you're more than welcome to do that. If for whatever reason a loan has been dispersed and you get a scholarship over the course of the year, and you just want to start repaying down some of the loan that has already been dispersed, you're more than welcome to do that as well. There's no penalty to do that. You're more than welcome to do it. We love to talk about how we are a responsible lender. So we definitely also want to encourage you to exercise the most responsible financial decisions that make sense for you. We have seen that sometimes students like to pay larger lump sum payments as opposed to putting in monthly installment payments. That's also something that we can structure for you. So if you don't want to repay every single month, you want to repay on a semi-annual basis or every 3 to 4 months, we're more than welcome, or we're more than happy to put together a plan with you to help execute payments along that basis. Right now, this last bullet point here is something that's going to be in flux. By the time you graduate, this won't be as relevant, but as of right now, we have a number of options for repayment. We have bank wires that we can facilitate a bank wire transfer payment. We also encourage a lot of our students to use TransferWise or Flywire. Flywire being the most popular choice in terms of repayment. You're able to repay from anywhere in the world. As of right now, there are some transaction costs to using one of these types of repayment methods. We reimburse you for whatever those costs are, but we're really working on, I think, a pretty awesome repayment tool that is very innovative, and I think we'll have that actually available, I would say probably by October or November. So by the time most of you are starting to think about repayment or even starting to potentially repay, we'll have actually a much more seamless tool for you, one that I think is going to be pretty cool. And as I kind of round out the presentation here, I think it's just important to kind of talk a little bit about our business model and how I think it's somewhat different from a lot of other lenders out there. One of the cool things, and I think, as you think about going to business programs, one of the core value props that you'll be looking at is exposure to a network of a broad network, right? And I think, part of the genesis of Prodigy Finance, and one of the things that I think we are beginning to do at a very high level, is being able to introduce opportunities to community members across our entire portfolio. So for example, say you're heading to engineering school at Carnegie Mellon, or you're heading to business school at Yale School of Management, for example, or University of Michigan Ross. These are all schools with great networks. One of the things that I think is interesting about the Prodigy community is that we think of it very much as a lending community, but also a professional community as well. So, one of the cool things about our product is that you're able to not only tap into your alumni network at a Michigan or Columbia or Yale or Stanford or Carnegie Mellon, but you're also able to tap into a network of 100 other or 99 other of the best business schools in the world, about 50 other of the best engineering programs in the world, about 25 of the other elite policy and law schools around the world. And so when you think about kind of mobility as a professional moving forward, I think that's also a very interesting and valuable business, and valuable value proposition for a lender to have. The other side of that too is that we have also been able to see successfully a lot of people who we have originally lent to come back around and invest in students that are either going to their school or from a certain geography that they might be very passionate about, investing in those students as well moving forward. So that's another thing that I think separates us as well. And we have been able to, as we do that, as we increase kind of the pool of investors that we have investing in students, we've been able to decrease the cost of capital and year over year really curate, I think, a more competitively priced product for you, potential clients of ours. And so one of the things that I'm super proud of, and I worked a lot on kind of what rates look like for this year for students and kind of how we determine those types of things. I'm very proud that, in an environment where we have seen rates kind of rise precipitously, like we were a lender that actually did not see year-on-year increases in rates across the board. So very proud to have that, and that's really a testament to the broad-ranging pools of capital that we're able to choose from, and that's really kind of buying into this whole idea that we really do grow through you. And so fingers crossed. Hopefully, this will be another year where we'll have a great year and we'll be able to at least keep rates stabilized. But I think that's something that we're super proud of this year, that we've been able to kind of keep rates consistent, and in some cases actually drop rates from what we've seen on a year-over-year basis. So with that, I'm coming to a close, and I just want to leave my contact details up. I'm actually going to be out of the office tomorrow and Friday, but feel free to reach out. I'm happy to answer any other questions that you might have, and I know we have a few minutes here for questions and answers, or put you in touch with the right relationship manager. Again, I deal with schools in North America, for schools in the U.S. and Canada, and I have some knowledge about the schools that we support rest of the world, so EU, UK, and Asia. But if I'm not the right resource, I'm certainly happy to put you in touch with the right resource to answer your question. We have a great team across the world, and happy to kind of connect you with the right person.
Okay, great. Michael, thank you so much for the outstanding presentation. All right, we have a lot of questions here. I have a couple more polls. Michael, do you want me just to go straight to questions since time is somewhat limited and there are a lot of really good questions?
Yeah, sure. Let's go to questions.
Okay, sounds good. All right, so Michael asks, I applied to 3 different schools, top 30 full-time ranked. I haven't been accepted yet. Can I already start the loan application process to find out if I could afford the school?
Yes, great question. So you absolutely can start the loan application process. The only thing that I will tell you is that you will only be able to get an offer. So if you want to move past the offer point, we're going to require that you upload a proof of admission to proceed with an offer. So you won't actually be able to accept the offer, but you will be able to see what your offer might look like across the 3 schools that you are applying to. Just so you know, also what I recommend doing, because I would imagine that there might be an I-20 crunch in that, since you are kind of still waiting for offers. I would encourage you, and I'm happy to kind of, if you want to send me an email, I'm happy to kind of give you a full list. It's also on our website of what those, what those supplementary documents are that you will need, and that will enable you to kind of get your application moving as quickly as possible after you do get that offer that you want to accept. That's what I would recommend. But you certainly are able to understand what your offer would look like without moving forward to accepting that offer before you've been admitted to a school.
Okay. Thank you so much. Vinay asks, what are the factors considered for me to be considered for one of your loan programs? How will I be assessed? I know you addressed this a little bit, but maybe you could go into a little bit more. And there were several other people who asked similar questions.
Yep, sure. So the first level of criteria is whether or not you're heading to one of the schools that we support. And so for business, it's a very simple test. It's, have you been admitted to one of the Financial Times top 100 graduate business programs? Is it a full-time program? Yes. Then you've kind of already hit the first level of eligibility. The second eligibility test is really, will you be classified as an international student at that school? And if the answer to both of those questions is yes, plus, if the answer to the question, are you from a country that we can support? And for the most part, 150 countries is very broad coverage. For the most part, the answer is usually going to be yes. And if the answer to all 3 of those questions is yes, then you've already kind of reached eligibility. In terms of assessment, as I mentioned, there's a number of things that we're looking at in terms of assessment when it comes to what your offer will be. And really kind of we're looking at, a number of factors in your profile. How long have you been working? What's your salary history look like? What's your history with debt? Have you ever been exposed to a credit product before? If you have, what's your history of repayment look like? What does the salary data from the school that you'll be going to look like? So that's what really, those are a few factors that we look at to determine what your loan size would be, what your interest rate would be. But in terms of eligibility to apply for a loan, we're really looking at, do you go to a school that we support? Are you an international student at that school? And are you from one of the 150 countries that we can lend to? The other thing that I will say, if this comes up sometimes, it's more specific to, I think, EMBA students or executive MBA students. If you've been in, say, the U.S. for longer than 7 years, that is also, as of right now, we would not be able to lend to you. But if you're applying to a U.S. school, and you are an international student, you don't hold an H-1B, and you have been in the country for under 7 years at the point of your application submission, you're fine. It's just any student who has been in the U.S. For over 7 years and is applying to a U.S. school, we would not, unfortunately, be able to fund those students.
Okay, great. Let's see what else we have here. Thank you for the thorough answer. Scott asks, do you have investors from SDA Bocconi? And he's asking because you said something about alumni from your school investing in Prodigy Finance as a factor that is considered in the amount of loan dispersed to a student going to that school.
Yep. First of all, great question. As of right now, we don't have any SDA Bocconi alums investing. But interestingly enough, next month we are having an investor event that we're sponsoring with SDA Bocconi. So perhaps out of that event, there might be some interest there. But as of right now, we don't have an investor from SDA Bocconi.
Okay. More great questions. Thank you all. You're a fantastic audience. And Encore asks, can I get a loan on a yearly basis instead of applying for 2 years at a single stage?
Sure. This is a very good question, and it's an important one, I would
Yeah.
say. So, particularly if it's a 2-year program, and look, I mean, you're more than welcome to do that. Here's the risk. If I can provide kind of a more broad answer to the question here. So, and I saw this with a student recently. That student did not apply for funding for the second year, and the way that they planned out their second year finances going actually did not end up playing out the way that they expected. And so they needed additional funding for us for the second year. Unfortunately, it was funding that we weren't able to provide because that student had actually taken the max amount that they could afford in their first year. So while you're more than welcome to apply only for 1 year of funding, it's not something that I would recommend. I would recommend applying on a very conservative basis for your first and your second year. And if you don't need that money for your first and your second year, you only need it for your first, you now know the max affordability that you have. So if you say, hey, actually, I have an additional $20,000. I won't actually need that. Let's apply it to the first year loan. You now have the visibility of knowing that like your max affordability was, let's say, for example, $60,000, and so you have the $40,000 that you had requested for year one plus the 20 additional that you could have gotten for year two, if that makes sense. But I don't think it's the best strategy to not understand what your full affordability is going into a program because things do change. So I think it's important for you, even if you don't take out that second year, it's important for you to know at maximum how much you would be able to afford with us.
Okay, great.
If that makes sense.
I think so. And then here's what's going to be the last question is from Sachin. Is funding limited to tuition fees or other expenses like house rent, et cetera? Are they also included as well? And you said, I think for most schools, it's tuition only or tuition and fees. For small subset of schools, living expenses are calculated or are also supported. Is that correct? Or could you clarify?
Happy to clarify. So in your budget, we'll be looking at the cost of attendance, so tuition plus living expenses. Now, there are some programs where we'd be able to cover both, and there's others that we would only be able to cover tuition. As a rule, for U.S. schools, we can cover up to 80% of the cost of attendance, so tuition plus living. Anything that exceeds tuition gets refunded back to you from the school. For schools in Canada, as a rule, we can fund only tuition costs. And so we can fund up to 100% of tuition costs. While we do ask you to put together, and while we do ask you in your budget to tell us how you'll be paying for living expenses, it's not something that we can actually lend to you for. And then schools, rest of world schools, it really depends on the school. So for example, at LBS, I know that we can now do living expenses, whereas last year we could not. At IAC and ASADE, we can only do tuition. I believe at IE, we also can only do tuition. So it really depends on the school. Rest of world, I'm not the expert on that, but if you go to our website, type in the school that you'll be heading to, you'll see exactly what we can do for that particular school on the website.
Okay, thank you so much, Michael. It's a fantastic webinar. And thank you all attendees for your attention, your time, your questions, answers. We really appreciate it. Michael has very generously put his contact information on the screen, so you can contact him after the webinar if you have additional questions. You can also post it on our blog at exhibit.com/PF, as in Prodigy Finance. As you leave, please take a moment to complete our short survey. We value your feedback, and so does Prodigy Finance. If you want to review this webinar, it should be online. The recording should be online early next week, and we'll send out an email letting you know when it's available. If you want help with your application, before you get to the funding stage or simultaneously, I guess, Exhibit offers myriad resources to help you with your application, essays, resume, interview prep, or just provide experienced advice. You can find all the above at exhibit.com/MBA, Masters in Business Administration, exhibit.com/MBA. Thank you again, and best of luck with your applications, both on getting accepted and getting money to pay for it. Take care. Have a good day.